Yes, sir.
Okay. Because I am using two laptops, I knew that as technical glitch. Okay. Okay, we'll start with it. Good morning, one and all. My name is Amit Anil Biraj, and I'm comparing today's event. Welcome you all for the international webinar on investment to create wealth. This webinar is organized by Department of MBA, NCET, that is Nagarjuna College of Engineering and Technology. This webinar is meant for investor, employees, businessmen, faculty members, and students. More than 740 participants have registered for this webinar. There are participants from various parts of India. I welcome all of them. Majority of the participants are from Bangalore, Chennai, Mumbai, Dharwad, Kolar, Udupi, and various places from Karnataka state. And also we have participants from Pune, Hyderabad, Salem, Vijayawada, Vizag, Chittoor, Delhi, and Coimbatore. We also have a participant from Saudi Arabia, Nepal, and other parts of the world. I welcome all of them. Such a overwhelming response we have received for this webinar. According to Robert Kiyosaki, rich people don't work for money. Instead, money works for them. He is the same person who has written the book Rich Dad and Poor Dad. Wealth creation is the process of creating, investing, and building a sustainable source of income so that one would not have to struggle to make ends meet. With these thoughts, may I request Dr. Prachi Berewala, HOD of Department of MBA, to welcome the dignitaries and the participants.
Thank you, Amit sir. Am I audible?
Yes, ma'am.
Okay. Happy morning, everyone, and namaste from India to our participants across boundaries. It's a pleasure to start this international webinar by welcoming everybody. Can I request all the participants to kindly mute themselves? Thank you. I, Dr. Prachi Biriwala, Head Department of MBA at Nagarjuna College of Engineering and Technology. On behalf of my team, welcome our Honorable Director, Dr. Gopalakrishna sir, our beloved Principal, Dr. Shrikant Murthy sir, and our guiding armor, Dr. Bhavani MR. I also want to extend my welcome to Dean Dr. Krishna Kumar sir, Dr. P. Harisha sir, and Dean Academics, Dr. Jitendra, along with our fellow members from Nagarjuna College of Engineering and Technology, Nagarjuna Degree College, and Nagarjuna College of Management Studies, Chikballapur. I would like to extend a warm welcome to today's speaker of the day, Mr. Girish K. Thank you so much, sir, for honoring our webinar series. And I'm pretty sure we will have a lot of learning from today's webinar. I would also like to welcome all the participants from India as well as abroad and our dear students. Over to you, Amit sir. Thank you.
Thank you, ma'am. It was a very nice gesture from your side. May I now request our visionary leader, great thinker and philosopher, Dr. S.G. Gopal Krishna sir, Director, Nagarjuna Group of Institution, to address the online gathering.
Good morning, dear all.
Thank you, sir. Good morning.
Esteemed guest of the day, Mr. Girish, Mr. Amit,
Thank you,
Dr. Prachi, Dr. Bhavani, Dr. Shrikant, Dr. Kumar, and others who have joined for this webinar. It's an interesting webinar. The overwhelming response I learned that there are about more than 700 people who have gathered for this. It is something indicating that money is important for all of us. Everybody will give importance to money. Without money, nothing will move. See, there is a saying, once somebody met money and he said, it seems that money, you are only a sheet of paper. Money said, yes, I am a sheet of paper. True. But people have not found a dustbin till now. See the importance of money. Warren Buffett has said, see, very interestingly, see, savings is not something what is left after you spend. No, that is not the statement. But saving is something, first you should keep that and then you spend the remaining amount. That is something interesting. See, look at the way people think of the saving and creating their own wealth. Probably such kind of attitude, such kind of thinking will create more and more wealth. We feel that there are a lot of opportunities anyhow. See, there are special incentives from governments for investments in public sector undertakings or some public funds like the PF or PPF or NSC, the post office investments, the LIC. See, they have given some kind of incentive just to encourage the savings among the working class, be it an entrepreneur or be it a working person. Everybody requires some kind of saving for their future. Unlike the Western countries where probably the social security is taken care and more importance is given for that, in our country we have to take care of ourselves. So therefore, savings we have to do. So it's a very interesting topic. Now, I was also thinking there are a lot of instruments for the investments. Like you have the simplest thing like post office investments or the bank investment like FD or something like that. Or you have the share market, you have the debentures, you have the mutual funds which have come in. See, there are some things like options and futures. See, these are all the instruments. But interestingly, Bitcoin is one more such a instrument which has come in the software form, soft copy form. So that is also very interesting. But what I feel is anybody investing and saving money, they should do it. They should start early and then start saving whatever little that is possible. When that is done, every day when they can accumulate, or every month or every year when they can accumulate, probably in a short span of time they will have a some kind of savings with them. I think that mentality should come. It's not that whatever you get, whatever small amount it is, that's why at the younger age, these children, school kids and children, they are taught the piggy box and things like that. You get, say, 1 rupee coin or a 5 rupee coin, you go and save it in the piggy box. That is for your own future. That kind of concept is very interesting. Therefore, there are a lot of instruments, but one word of caution is you have to take care of yourselves. Don't put all your money in one basket. That is for sure. I think the honorable resource person will agree for that. If you put everything in one basket, though the return may be higher, the risk that you are taking will be very high, and therefore it can go either way. It can swing either way. Therefore, one should be careful in putting their investments into different baskets. Number one. Then, secondly, whatever small that is possible, you should start early and start investing, start savings. Then, thereby, you can have a wonderful platform for yourself, the savings for yourself. I think which will definitely come in handy for you. Uh, I think with these few words, I'm very happy that Mr. Girish has agreed to give this webinar for the benefit of the students, investors, entrepreneurs, employees, everybody put together. Money is for everybody. That's why I said initially. And everyone requires some kind of saving, some kind of investment. Therefore, any knowledge that we gain out of such webinar will be definitely useful for our personal life, the financial life, what we call. It will be definitely useful. With these words, I wish this webinar all the best, and I should congratulate both Dr. Prachi and Dr. Bhavani for initiating such a wonderful webinar for the benefit of all the persons. I should thank Mr. Girish Kodashettar for his excellent initiative and sparing his valuable time to enlighten our participants of this webinar. I wish this webinar all the best. Thank you very much for giving me an opportunity to speak a few words on this occasion.
Thank you so much, Director Sir. Sir, I would like to include one thing here. Single-handedly, we cannot do anything. The entire team is very supportive, and the entire webinar, right from planning to, till today date, the credit goes to Amit, sir. He has been really putting a lot of effort for that.
Very good, very good. I should congratulate Mr. Amit also.
Thank you, sir. Thank you. Entire
Amit,
team effort, sir.
wonderful job. It's a good initiative.
Yeah, right. Thank you, sir. Thank you. Okay. Thank you very much, sir. It was a very great gesture from your side, and also it is going to be a great session, I guess. Every participants are going to participate wholeheartedly, and I request all the participants to reserve your questions and queries at the end. With this, may I request Dr. Shrikant Murthy K, Principal NCET, to say a few words for this gathering.
Yeah, thank you, Amit.
Thank you, sir.
Am I audible?
Yes, sir. Yes, sir.
Yeah. Respected Director, Dr. Gopalakrishna, today's esteemed resource person, Dr. Bhavani, Principal, Nagarjuna Degree College, Dr. Prechi, HOD of MBA, Amit, Dr. Kumar, and my dear colleagues, faculty members, students, and all the participants. Very good morning to everyone. It is indeed it's a very great effort by MBA department of being arranging a international webinar, and so far in this COVID period, we are all reaching different people, but in and around country. But now MBA has reached almost overseas countries also. My deep appreciation and also congratulations to this very dynamic MBA team headed by Prechi and anchored by Amit. And of course, the woman behind this is Dr. Bhavani. Under her able leadership, MBA is doing very well and very active in this COVID period. They have arranged very and different fields, the webinars in the different areas. Like recently they have conducted on HR, and today they are conducting on investment, which is almost everyone is looking at what should be our wealth in future. Because today we expend more and not worried about the future, right? We have to create wealth for future also. In this, what should be the investment across? Because whenever the economic crisis comes, we should survive. In that regard, this will help to save our money and invest in a proper firms or whatever the way. I think Grish will give you complete insight, and we are happy to listen to him, and we are eagerly waiting to him. I don't want to take too much of time. Anyway, once again, I congratulate Dr. Prachi and Dr. Amit and Dr. Bhavani for having arranged this webinar, and also very warm response by all the people, including business people and others. Thank you for inviting me and giving me an opportunity to address in this webinar. Thank you very much.
Thank you, sir. Well said, sir. Wealth is not meant for today; it is meant for forever. And wealth creation is a dream of every individual. With these thoughts, if Bhavani ma'am is there, then I will request her to address the gathering. Is she there?
Good. Yes, I am back.
Yeah.
Thankfully enough, I got the signals back.
Okay.
At the outset, I congratulate the team of MBA for having come out with such a wonderful theme for today's webinar. And I'm sure this is the most required theme at the moment, especially during the season where people are, getting jinxed about, investment and investing in the right perspective. So from that side, I would suggest that, this is one of the most important webinars coming up in the days. So I wish you all the best, and I sincerely thank the speaker for the day for having accepted our invitation to deliver this webinar for us. Thank you, and wishing you all the best.
Thank you very much, ma'am. Now I take this opportunity to introduce Mr. Girish Kodshetta. He is an engineer turned financial service professional with overall 18 years of experience, out of which 8 years he has been in financial services. His firm, Horn Merchant, is serving hundreds of clients across various products like stocks, mutual funds, insurance, etc. He regularly conducts investor awareness program to spread financial literacy. He writes blogs and articles explaining complex subjects of finance and economics in a lucid way. May I request him to address the participants? Girish, over to you, sir.
Thank you very much for having me here, and thank you very much for all the nice words spoken about me and for the introduction. I'm honored to be here, and hope I will add at least a little value to your needs and knowledge requirements, and it will enhance your existing knowledge, or it will bring. Yeah. Amit, if you have anything more to add, you can. Otherwise, we can start the presentation.
Okay. Okay. Shall I upload the PPTs? Okay. Oh, fine. Okay.
Shall I present?
Yeah, you can present. Yes. You can present. Yeah.
It's still starting now. And see who is good. Yours or mine.
You can see the screen? Girish, can you see the screen?
Yes, sir, we can see the screen.
Okay. Yeah, Girish. Hello. Click on Amit present. Amit presentation. Yep. Hello, Girish. Okay. You're trying from your side to present it? Yeah. Okay. Yeah. Fine.
No. When we are evening.
Yeah. Okay.
Like that. Hey, towel, man.
Yeah, start.
Tak.
Hello. Hello. Girish, can you hear us? Hello.
We can hear.
Yeah, you can present, Girish. You can present it.
I'm sorry, but as soon as I took up.
Yeah, you start. Not a problem. You can unmute it. Now, both I'm comfortable with. If you want to present it from your side, that is also fine. Now, in case there is a PPT related problem, I can present it. You can explain it. That is also fine with me. Share screen. Shall I do the needful?
Yep. No, wait.
Yeah, I will do the needful.
I'm trying to. My screen is visible now.
Yeah, you can Yes, it is visible. It is visible.
Yeah, I'm really sorry for the interruption. It got, I got exited, sorry. So welcome all, for all the people who have joined on webinar mode or live mode. Because we have already lost time in technical thing, I'll jump directly. So this is the home page of our website. Okay, I just spent on this to read out. So money can't buy happiness, wealth can. Wealth sets you free to what gives you happiness. That's why, wealth can buy happiness. So you have part of money and let money work for you. This is another snippet of the website on the home page. And so what we are trying to do is to create more equal society with respect to wealth distribution. Yes, we are into financial advisory, but I think at the very top level, what we are all at our firm doing is trying to help families to be more wealthy, so that the disparity and the difference in the wealth among the society is narrowed. The gap is narrowed. So in those two slides from the website, I hope you did not miss these keywords: happiness, freedom, more equal society, money, and wealth. There were phrases and sentences talking about this and making money work hard. And basically, how by making money more productive, all this is possible. And that more productive happens to be our brand's tagline. Now, in this context, let's see interesting numbers, which will make those words and phrases more meaningful and effective. This is the image graph from Credit Suisse's latest wealth report, which says that, which has found rather, about 82% of the world's wealth is controlled or rather owned by 11% of the people in the world. That shows, heavily skewed, heavily skewed in towards very few in the society and the world.
मनेरे अंता बंद इंता
Control.
गणेश भाई किन अंता वीडियो देखो मनोहर भाई आपका दुकान देखो शोरूम देखो हमारा घर देखो ये देखो वो देखो.
This isn't different in Indian context. That was the global, and in fact, more the countries developing or underdeveloped, the situation is much golden. So in India, just 1% of the top population, just 1% of the people control 45% of the wealth. That's staggering. And 10% own 75% of India as well. So why is this inequality? Why is there a wide gap between the wealth of people and few individuals? As most of the times, laymen think it's maybe the rich men are really, doing something inappropriate and not so good and fair. That's why
Girish, sorry to interrupt. Girish, sorry to interrupt. Your voice is not clear, audible. So if you have a microphone or if you come closer and speak, it would be audible to the audience. Yeah. Sorry.
Is it better now?
Yeah, I guess it is better now.
Sorry.
Yeah.
Okay, I don't know when I was not audible since when I.
This page you can this page onwards you can start, no problem.
Yeah.
Okay.
So what I was telling, there is a huge concentration of wealth and world's majority of the world's wealth is owned by very few in the world. So 11% of the world population, top 11% of the people control or own 82% of world's wealth. Same it is in India, where just 1% of the people own 45% of the wealth, and 10% of the population owns 75% of the wealth. And in India, actually, this trend, is further declining. So common people are owning less and less wealth. Maybe they are giving out more wealth to few. And why is this inequality basically? As popular notion, or we generally speak that maybe very rich people are doing something inappropriate. Because of that, the wealth or money, gets channelized, gets concentrated. There may be truth in that, but very little. But the thing is that these rich people or wealthy people have some attitude and habits about money and wealth. That's why it gets concentrated there, which majority of the people we don't have. Even if, say, suppose all entire world's wealth is distributed equally among all the people, it will again go back to the few people, because many people or most people don't have the attitude or the behavior to hold that or maintain that wealth or preserve that wealth. So to be wealthy, it's not just the money you have to invest, or it's not just the money is at stake, but more things. Like very important ones are time. So what's the time for? Time to learn continuously about not only about investment, the right attitude, and constantly to tweak it, and about asset classes, markets, and their cycles. We need an expertise there, and we need to continuously learn, unlearn, and relearn these things, because market situations and economy are very dynamic and things keep changing, and there is no other way but we also keep adapting to them. And we need to allocate time to manage risks in investments. We need to track it. It's not that once you have understood everything and you invested and forget it. It's not going to work that way. So you need to track it and need to take corrective actions, rebalance it. So we need to allocate significant amount of time to that as well. And very importantly, we need to give time to our investments. That is, we need to stay invested for sufficient amount of time. Basically, we need to have patience. And next, we need to have willingness to take calculated risk. Without risk, we cannot make we can't really create great wealth. And then we need to have discipline. Discipline, once we have learned and put a plan in place, we need to adhere to the plan, and if at all changes are required to the plan, we need to do it, review it, and do necessary changes, but we must adhere to a disciplined plan. So out of these things, what I mentioned here, there I have put some stars there, some hash, and some array. So basically, there are few things, if you cannot dedicate enough time, or you cannot have enough expertise, or do the complex calculations and all, you can hire a professional. You can hire a professional like me who can do all those things. But there are some things you need to bring to the table, like, of course, the money to be invested, and your willingness to take risk, and your cooperation. Both you and the advisor need to be disciplined. And so an advisor, even if you have an advisor, advisor can't do anything without your cooperation with the discipline. So let's learn about some effective techniques about each of these elements. Okay, like time and the risk and all those things. Money, as the sir was telling, we need to save first and spend next. As you can see here in the picture, so there is no point to fill the leaky bucket. No, first you need to plug the leakages so that before you start filling the pot. So usual attitude is that people spend first and invest whatever is or save whatever is left after spending. The right thing is mathematically equation is same, left LHS, RHS both are same, but it makes a huge difference when you income minus savings becomes expenses. That means you spend after saving first. But having said that, you don't have to overdo the thing also. That invest too much, save too much. Maybe we'll see that in the next slide. How is it? And there is one more thing about money. I have seen people who invest, or whenever you ask them or tell them, they say, I want to start, or I want to invest little money. I know people who have invested 15, 20 years ago, maybe very, very small because of, investing small attitude, things very small. Small or big is not anything in absolute. It's all relative. Small with respect to that person, individual person's, capability. That's what I mean as a small. So if a person can afford investing 10,000 rupees or 20,000 rupees, he invests 1,000 rupees or 500 rupees. That's what I say is small. So what happens? I have seen such people who have invested very small money and 1,000 rupees or 2,000 rupees 15, 20 years ago. And because it was small, they were not bothered about it. They never looked at it, and it's good actually. That way, they were very patient because it was also a very much important element in the investment journey. They were patient but unfortunately, they were patient because it was insignificant money. And when they went for withdrawal for 20 years, it was staggering. 1,000 rupees has grown to 40,000, 50,000. Obviously, they would have felt I would have invested more at that time, but the time has gone. Now, what this person would have been doing with this, even though investment has given 40, 50 multiple times growth, what the purchasing power or utility of what significant thing can be done? So you need to invest to take care of your future requirements and financial needs. And another big hurdle is finding money to invest. People say that I don't have money to invest. So they are earning very well, but they find everything is spent, because that's only because they spend first and try to save whatever is left. That is not going to happen. Never going to happen. If you spend first, you will be left with very little or no money. And like I was telling a little earlier, I don't want, because yes, saving is important, but don't overdo the savings also. And many people think that savings is the only way to create wealth. They keep on spending, saving too much. They try to save and bargain. And that's not really required. You don't have to be miser to save sufficiently. We need to differentiate between our needs and wants. Usually, our discretionary wants are our discretionary spends, and always discretionary spends are more expensive than our essential spends. So control, focus on your wants and control. You can compromise on your wants and discretionary spend, but don't compromise on your too much on your essential spends. And avoid instant gratification. What is instant gratification? No, I want to have everything right now. Okay, you have want to buy a smartphone or laptop. You can afford that. You have money, but the money you have is not just for today. The money you have earned today is also for today's expense and future spends. You need to understand that, and should not utilize all the money you have to whatever you feel like, whatever gives you satisfaction and gratification instantly. You should not spend on that. Postpone few things. When you avoid instant gratification, you will be able to have something better and bigger little later. That's what is postponing your gratification is called. And leveraging, please avoid leveraging. That's loan, taking loans, buying on, splurging on credit cards, overspending on credit, EMIs. Control your consumerism, and also avoid being paisa wise and rupee fool. Don't try to bargain for every pittance. 10 paisa, 50 paisa, 1 rupee, 5 rupee. Don't try to save that. Rather, focus on bigger things which will have more impact on your total budget. For example, I have seen people, you might also have seen people, bargain hard with vegetable vendors for 1 rupee, 2 rupee, 5 rupees, and they queue up in buying properties on bidding. That's the focus is misplaced again. Rather do the reverse. Do the hard bargaining when you're buying big things, and don't bargain. It's all, whether you bargain, it doesn't make sense. On small things, it doesn't matter much. And do a quick budgeting of your spends. Do analyze, and most of the time, only 20%. That, like Pareto's principle. There will be only few things which are big, will be forming about 80% or majority of your total expenses. Focus on those things and leave out the rest. Focus more about recurring expenses than, though they look small, but because they are continuous and regular, they will end up becoming big spend. The example is, focus more on choosing your DTH plan than how much you pay upfront for the set-top box. So that was about how if you follow those budgeting techniques, you will always find enough money to invest and save. Now, let's talk about the time. As you have popularly heard that compounding is the 8th wonder of the world, and further, the one who understands, this part of the quote I like the most. One who understands earns it, and one who doesn't pays it. So if you are not understanding the power of compounding, basically it's not just you are foregoing it, you are paying for it.
Girish,
and that's how
Girish, one second. If you have a microphone, can you use it? If it is there, it's fine, or else it's okay, no problem.
Unfortunately, I don't have.
Okay.
I don't have, unfortunately.
Okay. Our audience, whosoever is complaining, if you are not using microphone, it is not clear. So if you all can use your microphone, it would be easy for you to understand what exactly Girish is speaking. Okay. So over to you, Girish. No problem.
Amit, is it you are also feeling the same thing? Most of the people, if they are facing a problem, then something must be done for that. At least is it clear?
Some disturbances are there, not so much. I can manage whatever you are saying it. I can hear it, and as well as some disturbance, I can manage with it. I can understand what exactly you are speaking. That is not causing me a problem. But those who are not using microphone, for them, I guess so. It's okay. You can continue. I don't think so. It would be a much difficult. It's okay. It's okay. And I will tell all the participants that all the PPTs made by Girish will be shared with you. You don't have to worry about it. So it will be shared with you all, and you can come back to him again. So you can continue with it, Girish. No problem.
So compounding is the 8th wonder of the world, and the people, the reason, very much reason is that why we don't see such a big amount of gap between haves and have-nots, or the wealthy and the not so wealthy, is because very few people have understood the power of compounding, and they have been paying, for the compounding of the other people. Okay, so it's actually how long you invest makes more sense. It matters more than how big you invest. Here are some illustrations. Somebody investing ₹1 lakh for 5, 10, 15, 20 years, and every incremental longer period of investment or holding the investment, the gains are disproportionate. Okay, if somebody was investing for 10 years, if he stays invested for 20 years, though the tenure has doubled, but returns and the purpose has more than doubled. So that is disproportionate gain. That is because of compounding. And always, and a similar example, ₹1 lakh invested for 10 years will be, sorry, ₹2 lakh invested. 1 lakh will become 20 years goes bigger than 2 lakh invested for 10 years. So because, say, suppose somebody investing ₹1 lakh for 10 years, and to compete with him, somebody is investing double the amount for half the period. Obviously, the person investing smaller money for longer period will be the winner. So here, a person investing ₹1 lakh for 20 years takes back 11.5 lakh rupees, whereas person investing ₹2 lakh for 10 years only takes back 6.8 lakh rupees. So that's what highlights the time is more important than the quantum. So a little more about time. Similar example, there are two people considered here, Dinesh and Ramesh. So very interesting, at least especially the youngsters in this group or this presentation should understand this. So suppose Dinesh starts investing early for 15 years. Each of these guys are investing for 15 years. So what Dinesh does is very as soon he gets the first job, or because his salary is also small, then he can invest only 2,000 rupees. He invests for 15 years and then stops for whatever reason. He stops investing after 15 years. Whereas Ramesh thinks that he doesn't have enough money to invest, even invest small money also. He doesn't invest. Then he starts, once he gets a better job and he sees good amount of increase in his salary and income, then he starts investing after 15 years of experience. So with 15,000 rupees, and he invests thereafter for 15 years. So end result is after 30 years, okay, by just investing 3.6 lakh rupees across 15 years, Dinesh's corpus is 1.1 crore, whereas Ramesh's corpus is less than 1 crore. After investing 27 lakh rupees, across 15 years. So even he's investing more than 7 times more than 7.5 times of his friend. He is not able to catch up with Dinesh. So that shows starting early is very important. Time is more important than the quantum of the money. So, and another the infographic, what you see in the here is a depiction of that. This is an ideal case. This is how your investment or wealth creation journey should be. You start earning at a point and keep on earning, and you keep on saving and investing, and your money also starts earning money. Okay, not only you are earning, your money is also. Initially what the money earns is little. As the time goes, as your retirement nears, your money is earning almost equal to or more than what you are earning. And by the time you retire, so your income, what earned income stops, but only thereafter your money, because money can't, never retires. It will never retire from earning. So it will be earning forever for you, and that will be far more than your earned income. So you really don't get the pinch of retiring and not having salary income. Then let's move on to the risk. Risk is another willingness to take, or taking risk is inevitable in wealth creation journey. one must take risk based on his ability, willingness, and needs. There is a systematic scientific approach to calculate what risk is appropriate for you. So based on that, one must take risk, and without risk taking, wealth cannot be created. It's true that the real few, all these ultra high net worth individuals and businessmen, their source of wealth is entrepreneurship. And they have incorporated, created companies, firms, and that's how they amassed a huge amount of wealth. Yes, I agree. It's not possible. It's not everyone's cup of tea to be an entrepreneur. But take active role in entrepreneurship. It's not possible. It's not feasible, rather, because of the circumstances each person has. But it's certainly possible to participate in this enterprise, growth story, country's growth story. By how you do that is becoming part owner of those companies. Okay, it's a passive thing. You are a passive owner of that company or corporate, while entrepreneurs are active owners of the company. Even by doing this much, you will be able to stake your rightful claim on the wealth. And if you give it up, of course, only few people will be enjoying it. I've seen people who work for banks. They work day and night, and for their good 25, 30, 40 years for a bank, and they never, they rather want to invest in bank deposits than stocks of that bank. They are pretty sure that bank is going to be there honoring their salaries for next 15, 20, 30 years to come, and their pension if it's available, and thereafter also they think that banks are going to grow, then they invest securely in fixed deposits. Why not in stocks? Little amazing, a little surprising as well. So, and same way, the people working in IT sectors also, maybe they work very hard for those IT companies which will get listed and do great business, become very rich companies, very big companies, corporates. These are the people who are making it happen, but still they don't participate in the growth story by becoming shareholders of those companies. So it's actually, rather than avoiding the risk, we need to learn managing the risk by employing the techniques like diversification and asset allocation. We should try to manage risk than avoiding risk. And risk is everywhere. Risk is all relative, and overemphasis on risk will create disproportionate ineffective or inefficiencies in our wealth creation journey. So, because we are talking about risk, I wish you to show a short video about how the stock market in India has grown. It is volatile, definitely. So this is how the stock market has grown since its beginning. It has, you can see, there are a lot of events, lot of negative events. Hope my screen is, Amit, the screen is visible. The video that is being played is visible.
Yeah, screen and video both are visible. No problem. Both are visible.
Yeah. So I'm showing video. You can also see it later. This is on YouTube. I'm playing it from the YouTube only. So you see a lot of series of negative events that has caused a huge amount of volatility. But we as economy, as stock market, kept growing. So, so that's the brief quick journey of Sensex, how it had grown. So suppose if we had invested 100 in 1979, how it would have decreased in its value. Definitely, it was always its value was more than 100 rupees. And it has grown to multi-thousand. It was, the video was until 2017, and until then it was about 33,000, 34,000 Sensex. Today, after a huge crash and comeback, market is at around 38,000 plus Sensex. So 100 rupees would have become effectively 38,000. And this is without including the dividends. All these Sensex points will not have dividends that companies would have given. If you add back dividends to the Sensex, maybe Sensex will be looking like 50,000 points or 55,000 points today. So whatever points on Sensex you see is without dividends. So there was enough amount of wealth created, more than enough, rather, a humongous amount of wealth was created, and most of the people stayed away from it. And one more interesting question I frequently ask is, because stock market is volatile, what if people are apprehensive that what if stock market crash happens when I have to withdraw my money? I have invested and stayed invested for a long period of time, maybe 5 years, 10 years, 15 years. But then I want that money to be withdrawn for or to fulfill my goal. Then market crashes. But if you have really, as you might have seen in the video, yes, market crashes from the previous highs. It's not from the point where, from the level where you have invested. So suppose you look at a very recent crash in stock market in March 2020, this year, calendar year. Market fell from 42,000 points to 27,000. That's like 15,000 points in just few days. It's a huge, unprecedented, unseen, unheard kind of a crash. Okay, but unfortunately, assume if somebody had to withdraw, some emergency cropped in, he had to withdraw at that point of time. What would have been happened to him? But if this person had invested 10 years ago, okay, 10 years before that March 23rd, he would have made still huge amount of profit even after that crash, because his entry point should have been far lesser than 27,000 points. So, and then if he had waited for 2-3 months, again, Sensex is back to 38,000. Most of the time he can always wait if crash happens. There are other strategies, definitely. You don't have to, when the goal near you, better you gradually move your money to the safety. Those are the, that's an effective way of managing wealth and portfolio. That's different. Even if I'm taking the worst case scenario, and if somebody had not done that portfolio rebalancing and all, and just stayed invested foolishly, then also huge profit that person is making. So so this is about, there are some things, time and risks which are associated. When basically what I'm trying to tell here is, if you stay invested for long enough period of time, that itself will take care of the risk or probability of loss is very high in short term. And if you stay in, that's what I explained in the previous example. If somebody had invested 10 years ago, even after the crash, it is still be very good proposition. So with the time, the effect of volatility comes down. Yes, it is severe. Like if somebody had invested in the month of February of 2020 or January, beginning of this calendar year, and if he had to see the kind of crash in the month of March, where Sensex fell by 15,000 points, it's a massacre. You would have lost huge amount of money. But if you again wait for another 6-8 months, then market is back on its thing. When it falls too much, it will come back fast. When it falls very fast, it will also come back very fast. But that is the problem. That the short period of time you can incur loss, but that should not scare you from that. The history is the evidence that if you stay long enough period, these crashes do not matter much. So, and then as the sir was telling, yes, diversification is another technique with which you can reduce your risk. Okay, and actually people see safe returns like fixed deposits do not have any risk, but actually they also have a different risk. If you don't invest in you don't or willing to take risk in investments and stay invested in very safe investments for now, they are safe in short term. They are very risky in long term, because fixed deposit doesn't give you enough returns to beat the inflation. So, and very important, you have to mind whatever you are investing, your wealth, your trade is for a future consumption, isn't it? So, if it is not growing or keeping pace with the inflation, whatever you could have bought today for 100 rupees, and how can you buy that if your money is not keeping pace with the inflation? Because this whatever is costing 100 rupees today is going to cost 150 or 200 rupees maybe 10-15 years later. Then if your money has grown to only 150 rupees or 120 rupees, how will you be able to afford this? It's not possible. So that is the risk with the safe investments for long term. Safe investments are suitable for shorter period of time and not for long term investing. So you cannot break that habit of using FDs and safe investments for everything. And the discipline. So you need to be disciplined about everything in life in general, but more so in investments. We frequently hear about many complaining and losing money in investing in stock market or risky investment. That's because of their misbehavior or wrong decisions they have taken in the market. Because you have seen the market was giving good returns, market was growing only. It is the point of entry and exit they chose. That's why they made losses, not the market itself was bad. Okay, and in stock markets there are as soon people are introduced to the stock market, or as soon they start earning or get to know about the stock market, they will become traders. Everybody is behind that, making quick buck, quick wealth. That's not going to work. There is nothing wrong in trading, okay, but there also people don't most of the people who have heard making huge losses in stock market are traders who traded in leveraged positions like options and futures or even day trading. But again, clearly, there also they did not follow the discipline that is required for the trading. Even if discipline is followed there, also trading itself or trading also has a discipline to be followed, and if every successful trader has a discipline, and so definitely investing also. And one more thing people need to understand is trading always generates money or revenue. It doesn't create wealth. You look at any rich list of Bloomberg or Fortune or Indian, any rich list, you never see a trader's name in it. You'll see always Rakesh Jhunjhunwala, Warren Buffett, such people only. They are all long-term investors. They are not. You won't find. You won't find a single trader's name in the rich list. Okay, because trading never creates wealth. And a little more, discipline. This is what I was saying. It's like just a picture is shown in there about how we drive in the traffic. Is more expose us more to the accidents than the road and traffic itself. So how we behave or manage our asset classes, is more important than how the markets themselves behave. Okay, and there is one more infographic here. So this is a factual thing. Between 2013 and 2018. Between August 2013 and August 2018, BSE Sensex again without excluding dividends has doubled. Okay, it has become 19,000 to 38,000, means 15% CAGR, compounded annual growth rate. Okay, and large cap mutual funds have definitely, mutual funds are meant to beat the benchmark. If there is a Sensex is the benchmark, obviously they have to beat the benchmark, and they have delivered 20% returns. But how much an average investor has made is 10%, less than Sensex, less than mutual funds. Why? Because of their behavior, how they invested, when they invested, and when they exited. So investment has given this much return, but investor has made far lesser return than that. So that is we call as a behavior gap. So now that's enough of background and theory about this. Let's look at some practical ways of making money more productive. So insurance and long-term investment. So there are some criteria and approach. What's the approach? Approach is that so typically people will buy an insurance cum savings plan, but the better way to do is insurance plus investment way. I will elaborate what is that. So come to know the product. So people, most popular savings is that endowment plan. People will buy LICs, endowment plan, children plan, and such things, which are basically all put them under endowment plan. And the recommended way is buy a term insurance, and along with that, invest in hybrid mutual fund. So here is an illustration. Suppose you are investing 24,000 rupees a year, okay, and if you are paying 24,000 rupees premium on endowment plan, split that into 4,000 into 20,000. 4,000 rupees you buy a term insurance, and remaining 20,000 rupees you invest in hybrid mutual fund. And so suppose somebody is investing at the age of 30, and for 20 years he is investing, and what the sum assured typically the endowment plans gives is 5 lakh. In case of death of that person, family will get 5 lakh rupees. Okay, so but term insurance is a special. It's a risk only. It's like your car insurance or health insurance, which charges you only for the risk component. That means if you die, only the claim comes. That means family will be paid 25 lakh rupees. If nothing happens, they won't pay back whatever premium you have paid. Like car insurance, if accident happens, you claim, otherwise no. Like that. So because they're covering only risk, there is no investment portion in it. The sum assured they give is very large compared to the conventional thing. So it comes at 25 lakh rupees risk coverage comes at 4,000 rupees. Here 5 lakh rupees coverage is coming at 24,000 rupees. And this 20,000 rupees, don't eat your heart that I'm not going to get that 4,000 rupees back if I'm going to survive that tenure. That's the price you're paying, but no problem. This remaining 20,000 rupees will do the magic. So after 20 years, when on maturity you get, and if you survive, you are going to get 8.5 lakh rupees on this endowment plan. Whereas you are going to get 15 lakh rupees from this 20,000 rupees invested in this hybrid mutual fund. This 4,000 is not going to come back to you, but this 20,000 rupees invested in hybrid mutual fund will do 15 lakh rupees. So net, by investing the same amount per year, you ended up with bigger corpus, and if you survive, and if, may God forbid, if you die, your family got higher sum assured. In both way, it is better. So this is one way of making money. And cash building. What is the approach here? Safe. It has to be, your cash has to be kept safe, and it should be accessible anytime you want. And what is the typical product is savings bank account. So better option is you invest in liquid mutual funds. Liquid mutual funds are not connected to stock markets. There is a perception that all the mutual funds invest in stock markets. In fact, a large number of mutual funds do not invest in stocks. And bigger mutual funds, bigger AUM, assets under management, is in non-equity mutual funds. So that's the thing. So interest what you get. Again, this is little dated information here. So savings bank account is not giving 4% now, it is giving 2.75% here. So and liquid mutual funds are not giving 6 to 7% anymore. They are giving you 5 to 6% return. So comparably still, the comparably against 2.75%, they are almost giving double the returns. They are giving you more returns when interest rates are 4%, they are giving 7%. When the interest rates on savings bank have gone down to 2.75%, 3%, they are giving you 5-6%. So liquidity in both the cases, it's high. You can, whenever you want, you can withdraw. So just by choosing a better product, you will be able to manage your cash more productively with higher interest. Then if you have a short-term investment for 3 years, so what is the typical people most popular one is bank fixed deposit. The safety is high here, yes. There are debt mutual funds. Again, there is one notch up on the liquid funds. They are also not debt mutual funds. Also, they are bond funds. They invest in bonds. So majority of the audience should be able to understand what I mean by bond and debt. So both the cases preserve the capital here, and absolute returns are not 8 and 9% anymore. Those are the days gone. So maybe at present you make 6% here in bank deposit and maybe 7-8% on debt mutual funds. This is very important. Tax on return, post-tax return wise, debt FDs are very inefficient. Yeah, this is very applicable to the people falling in tax brackets 20% or more. So if somebody is not falling in tax bracket, then fine. Yeah, the returns are slightly more than bank fixed deposit. But somebody who is in tax bracket, post-tax basis, debt mutual funds offer far better returns than bank deposits. Then another thing is investing in or buying gold. So what is the thing is the typical approach is people buy gold, jewelries, and purity is always 92%. That even you buy that what is that BIS hallmark? BIS hallmark is at 92%, 22 karat gold. It's not 24 karat gold. So, but if you buy, invest in other way in pure gold or exchange traded funds. Gold ETFs are a special type of mutual funds which invest in only gold. And very, very interestingly, now sovereign gold bonds have come. So sovereign gold bonds offer you interest on the gold you hold. Otherwise, gold is a dead investment. It doesn't earn any it doesn't earn any interest. Whatever the value of capital appreciation gold has, that alone is the return for us on gold. But SGB is not like that. Sovereign gold bond offered by Government of India gives you 2% interest on gold. So that is another productive way. So resale value of a jewelry is always less than what you bought. Only 80 to 85% of what you paid you will make, or that day's present, that particular day's market value. Here in these auctions, you get 100% of that day's market value. So there are additional costs in making jewelries and other things. Yeah. So only problem with the other way this thing is consumption. So suppose you want to use this gold as an ornament and all, yes, it's not possible with these new methods like pure gold ETF or sovereign gold bond. Yeah, you cannot wear them. But here what we're talking about is also not about wearable gold. It is for more in context of investment. So now a little more deeper dive. So how you should arrange your financial life. These are very simple. Hello. Yeah. So these are 4-step approach. So suppose almost everyone's circumstances. Step one is create an emergency fund. Okay, emergency fund is, what is emergency fund? Emergency fund is a corpus meant for emergencies. At least 3 months of your income or 6 months of expenses should be kept in as a reserve, and no other time like what the current situation is ongoing can explain or make us realize the importance of the emergency fund. People are going out of business because of the COVID. They don't have, if you are a businessman, you don't have business for continuously for 3 months, first 2 months of lockdown, absolutely no business. And people who were employed in those businesses under lockdown are also not getting salaries. And what they will do, and then even after lockdown, even at present, businesses are not making enough money. There are people are losing jobs. So if they did not have a fallback plan, if they did not have this emergency plan to survive for 3 months, 6 months, how do they manage the life? It is very difficult. So this is a situation which makes us think a lot about emergency fund and its importance. So always we need to create a purpose of at least 6 months of expenses or 3 months of our income kept separately liquid, for emergency purposes like the current one or something else. And the second step is, and also there is another thing there in step one, is insurance. You need to buy insurance, and that's the first step. Enough adequate insurance for life, accident, and health. That's the complete health. You need to cover yourself against all adversities of life. Those are the things. Then step two is investing towards your all essential time-bound goals, like what, your children's career, your retirement, your aspiration of owning a house, such things. If or your children's school admission or such things, whatever are time-bound. So these time-bound goals may be divided into short-term goals, medium-term, and long-term goals. Short-term goals, you invest in bank deposits, debt mutual funds, and conservative hybrid mutual funds. That's what is suitable for short-term investment. Medium-term is 3 to 7 years. What are appropriate for that are hybrid equity mutual funds, dynamic asset allocation funds, conservative diversified equity funds, and long-term equity funds. I'm not going into the details of what each particular products are about. I'm just giving, because keeping the time constraint in mind, I'm just telling you what is appropriate for that particular market. Then step three is discretionary and not strictly time-bound goals. Okay. What they could be, suppose the default retirement, I want to retire at age 60, I must retire by age 60. But suppose I'm aspirational, I want to retire by 50, that I want to prepone my retirement by 10 years. This is discretionary, it's not time bound, it is not mandatory. Or it could be something else, I want to go on an international tour once in every year, like that. These are not time bound or very strict mandatory goals. For that, you can take a little higher risk, and so first time-bound goals. You don't take too much risk there. Invest in, or rather, delegate that responsibility of managing your money to the experts through mutual funds. They are experts in managing investments. They will do it. And for this thing, you can go take a little higher risk and go for equity shares directly, and you can invest in portfolio management services, PMS like that, which are obviously they take higher risk and obviously they offer higher returns also. So if you tend to incur some loss there or don't achieve your target returns, fine, that's okay. Nothing to lose there. Then the step 4 is income distribution. There will be a stage after you retire, you need to arrange for your regular income thereafter, because you are not going to get any income or salary thereafter. So your income will start giving you cash flows. The right tools or products at that point of time is annuity plans, debt mutual funds, and even bank deposits. Okay, and at the same stage, you need to also do the succession planning. This is a very, very important aspect which is neglected by almost all the people in the society. It's about will and creating the trust or drafting a will, so that we ensure that our whatever we are leaving behind is smoothly transitioned to our next generation. So these 4 steps will capture all the important things you should be doing to organize your financial life. So then this is the last section, retirement planning, and depending on your life stage, what you should be doing. So I have divided your life stages into 3 broadly, and 3 stages, and within that each stage I can divide it into 2 sub categories, sub stages. So your this early accumulation is the phase when you accumulate your wealth. Okay, in that you are funding for your goals, preparing yourself, saving and such. So this typically this range is age range is 25 to 40, and within that 25 to 30, when you just start earning, or somebody might have got job at 22, 23, or somebody may start at 25. But that phase, 25 to 30, the income rises rapidly, and expenses are fairly very small, because it's most of the time it's a single person or very small family. So they have the potential, or each person in this phase has the potential to save more. But what really happens is, and to an extent fair also, that youngsters have newly found their financial independence. So far they had to be dependent on their parents for whatever expenses they had to incur, or whatever they wanted to buy. Now that they have come to the adulthood, and they have started earning, they want to, obviously, psychologically they want to exercise and indulge into that exercise their newfound financial independence. So in want of that, what happens is they end up buying lot of unwanted things. But if they are guided well and handheld at that stage, this wasteful expenditure can be channelized into savings, though relatively it is small compared to what they can save and invest in later stages. Compared to that, this sum will be smaller compared to based on their salary. But this is as I have shown in the previous examples, in Ramesh and Dinesh's example, even though this small amount will translate into far bigger corpus than the amounts that what later bigger amounts what they can create. So it's very important to not to lose track at this stage. So what happens next is age category 31 to 40. So both income and increase, because family expands, and expenses also increase, and definitely incomes also increase. And but now some contingencies have come in place which are not there in an earlier stage. So whatever I'm talking about, investments, fresh investments in each stage. Okay, so the first stage, previously during 25-30, they can invest extremely aggressively. They can put everything in equity and leave it for a very long term. But in the next stage, there are some requirements, some contingencies for which some provision has to be made. So maybe about 20% can be kept in bonds, and 80% can be exposed to the risky assets. So that the picture beside is an indicative of the attitude or that stage of life. Okay, during 25-30, you are very aggressive, can be aggressive and very agile. So 31 and 40 like that, like a horse. Next stage is advanced accumulation stage. So this is 41 to 50 age. During 41 to 50, obviously the person typically has a more mature family and commitments have increased. And this is the stage when actually people realize or they start thinking about their retirement. Before this they won't even think also, and at this point of time they really start thinking. They don't do it, but they start thinking about it. They should have started it in the very first stage for their own good. Now there are bigger expenses to be incurred here, like children's higher education and this thing. So portfolio has to be having, yes, you may have you may have separate goals and separate provisions and investments for taking care of those other goals like children's career, graduation and other things. But still your retirement portfolio need to be having some cushion and buffer to take care of some unexpected runouts. If school, college admission fees, instead of you plan for 5 lakh rupees, is coming to 8 lakh rupees, you need to have pull out more money. So you need to have little liquidity there. So portfolio cannot be very rigid and aggressive there. It has to be a little more flexible and liquid. So at this stage, maybe whatever money fresh you're putting, that don't put very all that into equity. Maybe 60-65% allocation is appropriate. The next stage is when about age, it's advanced, little older age, 50-60. Typically, almost everybody will be at the peak of their career and earnings. Their income, irrespective of their businessman or salary, they will be at their peak earnings. They will be earning far higher than what they used to earn in their previous phases. And family expenses might have slightly reduced. And the EMIs and other commitments might have ended or nearing completion. So at this point of time, people will have larger sums to invest, but they will not have what they will not have. They have money at this point of time, but they don't have time. More time left until they retire. So nonetheless, they can invest about 50% into equity to safeguard. They cannot take too much risk because there is not enough time there. So then the last phase is the distribution phase. Distribution phase is the phase when we need to make arrangements for our retired life. Month on month now, our investments, our corpus should start paying out. So what we can do once you retired, your entire portfolio, whatever investments you did right from your early stage at the age 25 to up till age 60, you need to take revamp your portfolio and align it to have a relook, and readjust, not just look, but readjust and revamp it to suit your retired stage. And again, in retired stage, doesn't mean that because you have retired, you have to keep everything, all the amount in safe like FD or something. It's not like that. You need to create basically 4 sub corpuses. You have a big corpus of 2 crore, 3 crore. You need to divide that corpus into at least 4 sub corpuses. And first sub corpus is for your first 5-year and next 5-year and like that. So at least divided for next 20 years, whatever you need, the first sub corpus which you need for first 5 years, keep it very liquid, very safe, and keep on increasing the risk to the farther and farther block. Okay, so the next sub corpus or block can be little in higher. In this infographic I've shown here, the liquidity and growth is how much risk assets or how much returns you're expecting. Overall, yes, it's true that overall the risk appetite should have come down, but within that you can still have no room for taking higher risk, because if you keep everything in a very safe thing, you may be compromising on better returns, because blockwise, there is still a lot of time left before you consume that block. So those blocks belonging to the farther periods may be exposed to some moderate to higher risk. So that's all I had. If you have any questions, please ask. I'm very, very sorry for poor audio quality if I was not audible at some of the slides or most of the slides. Please excuse me. Amit, that concludes.
Thank you very much, Girish. It is open for question answer session. I would like to request all the participants to post the question in the chat box so that I can say what you wanted to communicate. In case redundant questions are there, we can avoid those questions. We can ask only those questions which are same or similar line or different questions. Okay, you can ask questions in the chat box so that I can ask that question to Girish. First question is, diversify funds properly into a different stock. Whether the diversified funds are, whether they are properly distributed in different stocks. Girish, am I audible?
Yeah. Yes. Yeah. Each mutual funds, if you're talking about diversified equity mutual funds, each mutual fund, whether diversified equity mutual fund or something else, has their clear mandate, investment objective, that where should they invest, not particular specific security, but in what kind of security they must be investing in. So if you read the investment objective of a equity mutual fund as a long-term wealth creation through diversified portfolio of equities, stocks, this is how the typical investment objective reads like. So they have the mandate to invest in diversify the portfolio. They have the mandate. It's a rule. It's a rule or a regulation on them. They are bound by that. They must do that. Typically, a multi-cap fund, a diversified multi-cap equity fund will have really invest across large cap, mid cap, small cap, maybe about 50-60% in large cap, 20-30% in mid cap, and 20% in small cap. It will be truly diversified, no doubt about it.
Okay, one more question was, what exactly the difference between need and want?
You can look at your own this thing. Okay, let me give an example. So suppose I'm an employed person. Assume I'm an employed person working for a corporate. My office is maybe some 5 kilometers away from my home, and I want to commute daily. Of course, I need to commute daily, and for my daily commutation, I need a personal transport vehicle. So this is a need. So to need this, to cater to this need, I can buy a Hero Splendor, okay, or any 100. Just excuse the brands and names. Just for the easier understanding, I told those things. I don't recommend or endorse those things. So you buy a typical 100cc bike. You can buy that, which is very cheap, and or even a scooterette. But you with that excuse or reason, you buy a very expensive sports bike or a Royal Enfield. Just again, for example, quoting Royal Enfield Bullet or Harley Davidson or something very expensive. That is want. Yes, you have the aspiration to own. It's your childhood dream to ride a Bullet. Okay. Yes. Now this need comes up, and you exploit that opportunity and rationalize your reasoning that this is why you bought that. That's want. We need to. That's the difference. If I have to give it an example. Hope this is clear. Or if you want me to clarify further, I will do that.
One more question was whether it is possible for anybody who is aged between 35 to 40 can do an early retirement plan. They wanted to get retired at the age
Anybody
of 35
can
to 40.
do. Oh, 35 to 40. See, 30. If you have to talk, want me to talk practical terms, it is little outlandish goal. 35 to 40, retiring at 35 to 40 is outlandish goal. You should have started earning at the age of 2022, and you should have started from the day one, and you should have had the goal to retire at 35, 40. Then it was possible. Anything is possible, but they need to be goals, need to be reasonable. No goals we call them what we call that smart goals. Reasonable and measurable, and those things, right? So the goals should be like that. Otherwise, it will be a wish. You wish to retire at 35, 40, or you want to retire today, right now. That's a wish. That's not a goal. Goal should have a plan. Yeah.
Okay. Is there a possibility for a person to make a proper investment plan with 1 lakh rupees? Can you substantiate with an example?
It is possible. Why not? But just with amount you want to invest, I cannot, or anybody cannot tell anything, because there are more questions to be answered. The moment, or anybody, this is a typical regular exercise. People will say that I have X amount of money, I want to invest. Fine. For what duration, for what purpose, and what is your risk tolerance? These are the questions to be answered. Once you have answered these things, accordingly we can choose appropriate investment.
Okay. Which is the better investment avenue for mutual funds? Which is the better mutual fund avenue? And that is debt fund, equity fund, balance fund. Which one it is? They are asking.
There is nothing like one size fits everyone. These are products that are based on your needs. Like, it is typical of you asking that there are whether, again, going back to the same thing, should I buy Hero Splendor, Royal Enfield, Harley Davidson, or something else? There are products available there. Each cater to different needs and segments. They have a different purpose. Depending on your purpose, you can buy that. Again, sports car, normal entry-level car, hatchback. There are so many variations. There are hundreds of thousands of products in everything in our life. So you need to understand what is my requirement and appropriately choose which is fitting that bill appropriately.
And as of now, SIPs are having a lot of fluctuation. That is, systematic investment plans are having a lot of fluctuation. Is this the right way to go forward, or do we need to come out with some other plans for mutual fund investments?
SIPs do the best job if the markets are volatile. Okay. SIPs are meant for volatile markets, and you should be happy that you are running an SIP in volatile times. If the market is going up, actually, if you are investing in upward, and that's not a good SIP. If you do the calculations, you will come to know upward trending. You should always be hating SIP in upward trending market. You should be very, very happy in volatile market, because SIP is, what is the objective of the SIP? To take advantage of the volatile market. That's why the SIP was invented. So that means, let me explain. So when this month's installment is going, market was high, and then by the time next month's investment was going, the market was low. So that means this is volatility. Like now, because you bought at 2 different points of time, your cost of acquiring has averaged. Okay, so they are doing the best job then. So continue your SIPs during the volatile markets. That's when the SIPs are doing the best job.
Okay, a few more questions are there. What is the risk of investing in post office investments or savings?
In relative sense, there is no, because it's the government of India is what backing them. Postal savings in context of India don't have any risk. Again, see, like this concept of risk, you need to understand it's always relative. It's not absolute. There is nothing in this world which is absolutely risk-free. Now for Indians, government of India, because this is backed by government of India, we may say that government of India will never default. Okay, but you have to understand what is the, we are almost, you might have read in the newspaper now, India is running, we are just one notch above the, junk as a country. Like, you grade these investments like risk, more risk, less risk, and moderate risk. Even countries, as with respect to their investment quality, are rated by rating agencies, Standard and Poor's, and like many other rating agencies. And you know what is the Indian rating is BBB. It is just one notch, above junk. If we are downgraded to junk, no foreign investor will invest in India. Okay, we Indians, we feel very high about Indian government, but you have to see in the global context, we are at the bottom. So the highest rating is AAA, AA plus, AA minus, and A plus, A minus, then BBB. Then we are at that level. So, and because of whatever is ongoing, we run the risk. Recently, from BB plus we are downgraded to BBB. And one more notch, we are into junk. A lot of money will flow out of India. So that means that government, outsiders are doubting whether India can, pay back their money if invested. So that's what the rating indicates. So in our context, in the Indian context, they are safe, but in global context, they may not be safe. I will give an example. You want to make you feel how the country's rating affects psychology. So suppose, and it is true also. It's not. I'm not telling this thing. I'm not telling anything imaginary. True. Now, government bonds. If you invest in government's bond today, you will make about 5.5% returns today. Government, if you invest in the government bonds, government of India bonds, government of India will give you 5.5% interest. Suppose if you invest in Pakistan government bond, okay, or say Uganda government of bond, or don't nothing negative here, only financial things, okay, they will give you higher returns. Those government bonds will give you 7%, 7.5%. Okay, will you invest? You are allowed to invest in Pakistan government bonds. I mean, not Pakistan because it's an enemy country, but leave the negative this thing. Nepal government bond, for example, they give you higher return. Okay, 1% or 2% more. You are more. Do you feel the risk now? What Nepalese or Pakistanis thinking that their government is supreme for them. They believe that the government will not default. Then why you are? So that is what the risk is. Government of India will not default in Indian context. We believe government of India will not default. That is why in India, government of India backed governments are free. But this is related. Yeah, that's a long answer for short question. Any next question, Amit?
Feedback form.
Hello.
Hello. Can you hear? Hello, can you hear me? Hello.
Yes, I can.
Okay.
Yeah.
So there are two questions which I am going to club it and make it one. So first question, part of it is, in case if I made an investment in equity and the company completely shut down, will I be able to get any return from that? And the second question is, in case if I am the age between 25 to 35, what is the best suitable investment avenue? If I am of the age above 40, what is the best suitable investment avenue? Two sub questions, and that ends, I guess.
Yeah, I think this thing, equity, a company, if you are holding a stock of a company and company shuts its door, it's a difficult situation. Most likely, you will not realize anything. I mean, this I'm telling you practically. Company, what happens is company goes into liquidation. Okay. Now there are live examples ongoing now. For example, big company just recently, Diwan Housing Finance, Island Affairs. These were very huge corporates which have filed insolvency. Their stocks have been delisted from the stock market, but you may continue to hold these stocks. But companies are under liquidation. So what is it? It's their liquidation is selling all the assets of the company and paying off the liabilities, because they will have creditors, depositors, and so many other people, their employees, and so those employees' salaries might have been withheld. These liabilities have to be cleared, and the taxes might not have been paid. First, government will take the first cut. Government liabilities or tax liabilities must be paid. After everything is paid back, if anything is ever left, that will be shared among shareholders. Most of the cases, practically, shareholders won't get anything. When the company goes into liquidation, it has gone into liquidation, it has gone into insolvency, because that is the stage. They don't have anything. Their income is far lesser than the same. So mostly shareholders will not practically get anything most of the times.
And last part, that is, which is the right investment of NU for 40 plus and 20 plus?
So I have kind of touched upon this in my presentation in different life stages, so what is appropriate and how they should be looking at. There is no particular, pinpointed specifically. I cannot say that you invest in this stock or this particular scheme. That requires little more, questioning and answering, and then understanding the needs, and then you can do that. But generalistic, what you should be doing, I have touched upon in my slides there.
Okay. Thank you very much. And probably there are endless questions are there, and we won't be able to ask all the questions as we are running short of time. And definitely we will allow you to ask these questions to Girish Kodeshatta in person, because his email ID will be shared with you, and you can ask those questions, and he definitely will reply it back to you and reserve those questions. And as of now, we are having other commitments from other participants as well. They are requesting us for a feedback form. I understand it, because we are short of the time, and it was really a wonderful session, and I take this opportunity to propose a word of thanks. We have come to an end of international webinar. I, Amit Anil Biraj, on behalf of Department of MBA, NCET, and the entire organizing team, and on my own behalf, extend a very hearty vote of thanks to today's speaker, Mr. Girish Kodeshatta. He explained the investment concept in a most simple manner. And thank you very much. And it was really a wonderful and informative session. Probably those who are from finance background, definitely they will understand it. That is, a lot many things have been touched upon. And whenever we plan to make an investment as such, we will run for the pillar to post to find out the right person who can give us a one-shot solution for all our investment doubts, right from mutual fund, insurance, health insurance, then if it comes to equity, debenture, etc. All these are confusing for those guys who are not into a finance field, etc. But finance is the one concept which must be known to everybody. Rich Dad Poor Dad book also says it only one thing, that is, financial literacy has to be the mandatory literacy for every individual at a school and collegiate level. But unfortunately, that kind of schooling doesn't take place. They expect individual to learn on their own, which doesn't happen in reality. So I have seen my friends struggling with their investment options in spite of having a huge earning in per month basis. Thank you, Girish. It was a really, really wonderful session, and I couldn't take more of the questions which were posted here. And feedback form will be shared with you all. And thank you for your great presence and all. And I would like to ask any of the participant would like to share something. First, post it in the chat box, so that I will allow you, because I can allow only 2 to 3 feedbacks to come forward, and remaining is we'll be about to end the session. 2 to 3 feedbacks, we can take it forward.
So we can request Satyanarayan Raju sir. He's our counselor at NCET.
Right, sir. Right,
Satyanarayan Raju sir, you can give your feedback, please.
Raju sir, are you there? Prachi ma'am, sir might not be in a position to get connected, I guess.
Yeah, I think so. There's an
Yeah,
issue.
okay.
Anybody for that matter.
So anyone?
So, meanwhile, I would like to extend my heartfelt gratitude and thanks for this opportunity, having allowed me to connect with all the people here and share whatever little I know with all of you. Thank you very much.
Thank you, Girish. Thank you very much.
Thank you so much, Mr. Girish. It was definitely a very insightful session. Thank you so much. We'd like to connect with you in future as well. Thank you so much.
And we have come to an end of the session. Feedback form will be shared. And thank you very much. And have a great day. And so for some people who have put up abroad, they may be starting now. So have a great day. Okay. Thank you all.
Thank you so
So I
much.
just
Amit.
share I just share the feedback form now. Right. Thank you. Yeah, I shared the feedback form. You can check it out, and please do fill in. And changes will not be permitted immediately, so it takes a lot of time for you to make changes. Please fill your name correctly and the email ID correctly. We got a lot of email bounce back. Reason being is that email IDs were not given properly. So please ensure that you fill a feedback form the way you wanted your name to appear in a certificate, and also give a right email address. Thank you, one and all. And we are done for the day. Thank you for everyone for your support and encouragement. Thank you all. Prachi ma'am, shall we end? Hello.